Sure. Thank you. Thank you.
Right, one more coming in. Okay, good morning, everyone. Welcome to the Foreign Correspondents Club of Japan. I'm Anthony Rowley, former president of the club, and I'll be acting as moderator today. Before I say anything else, I'm afraid I have to announce that Jesper Cole, one of our panelists, was taken rather ill during the night with very serious pains in his stomach, and he's been taken to hospital. So I've sent him our best wishes and hopes that he'll make a speedy recovery. So I'm afraid there are 2 panelists rather than 3, but it's due to circumstances beyond our control, as you'll understand. Okay, let me first introduce the panelists. On my left is Hiromichi Shirakawa, who's Managing Director, Vice Chairman and Head of Economics and Japan Chief Economist at Credit Suisse Securities Japan. And on my right is Richard Katz, who's a special correspondent for the weekly Toyo Keizai and a senior fellow at the Carnegie Council for the Asia Dialogues Programme. The title of today's event, as you know, is How Long Can Japan Hold the Line on the Yen? And of course, there have been some interesting developments even overnight on the yen rate, which I believe is now at 141 to the dollar. And of course, we had some very exciting, or whatever you want to call it, news yesterday in the sense that the rate of consumer price inflation in the United States has decelerated to 7.7% in October. But all I would say in a way is that as inflation continues, I think perhaps you would expect to see some reduction in the rate or the increment as the absolute level or base of inflation grows higher. But I'm not the expert in this. I'm going to hand over to our experts. And first, I'm going to ask Shirakawa-san to give his comments. Shirakawa-san, as I said, joined Credit Suisse Japan, Securities Japan in 2006 as Managing Director and Head of Economics for Japan. In June 2017, he was appointed Vice Chairman of Credit Suisse Securities Japan. He began his professional career at the Bank of Japan in 1983, and he spent around 16 years mainly in charge of research and analysis of money and credit markets. He was a special assistant to the governor of the Bank of Japan in 1997 and 1998, and from 1991 to 1994, he was a senior economist at the Organization for Economic Cooperation and Development, or the OECD, in Paris. And from November 1999 to March 2006, sorry about all the dates, he was chief economist at UBS Securities Japan. So with that introduction, Shirakawa-san, I'd like to hand over to you. Thank you.
Okay, good morning, and thank you again, for giving me a chance to speak this the very kind of high-level talk show, I would say. So today's topic seems the yen and Japan's policy, in particular monetary policy implications. Well, I'd like to make 4 comments at the beginning. First of all, on the yen's depreciation, we think it is a kind of combination of 2 effects. One is obviously Japan-US interest rate differential or monetary policy direction difference, but the second background seems a structural deterioration of Japanese economy. So we do not think the monetary policy differential only accounts for the current weakness of the yen. And in our estimate, or due to our quantitative analysis, yen seems to be undervalued, roughly speaking, by 20 yen if you do a model of interest differential. So interest differential can explain up to 120, 125 to dollar, but above that, in our view, deflection of the structural deterioration of the Japanese economy. And second point I'd like to make is on that structural deterioration of the Japanese economy. I would say there are mainly three backgrounds. One is the secular decline in competitiveness of Japanese manufacturing industry. That is, I would say, a very serious issue. And after the COVID pandemic shock, the impacted the global economy, in particular supply chains, what has become more obvious has been that Japanese manufacturers are fairly weakly positioned in terms of the supply chain. In particular, auto industry has been suffering for a long time after the COVID pandemic shock happened in terms of the availability of parts. And also we have seen still the issues of shortage of chips or semiconductor related products, internet availability. So that has impacted Japanese export performance. And one interesting thing is that even if the yen has weakened a lot, the export performance, in particular real export performance, export volume performance, has not been so, I would say, has not improved much. So competitiveness issue is the first background for the structural deterioration I'm talking about. The second one is the maybe relating to that somewhat, but productivity of the economy has come down. And one very symbolic data is a import penetration. Import penetration is import to GDP, which has climbed on sustained basis, almost no change in trend, and imports to GDP continue to go up. And it is a bit anti sort of, I would say you tend to feel, okay, import prices have picked up a lot. That should have a dampening impact on imports, in particular import volume, but that is not happening. It may take a bit of a long time lag, but we haven't yet seen any major dampening impact on real imports from yen depreciation or significant increase in import costs. And of course, one typical example is smartphones. So many are still looking for or trying to buy iPhones, which is not produced in Japan. So import penetration is a big issue. And again, this is the second background for the structural deterioration. And third one is terms of trade. So to be straightforward, exports actually in terms of the contract, price contract, 50%, 50 is dollar-based. Imports 70 to 75% dollar-based. So theoretically speaking, or I think very, very straightforward outcome from the yen depreciation is that export prices rise less than import prices. So automatic impact on terms of trade of yen depreciation is on the downside. So yen weakens, terms of trade continue to deteriorate. But on the top of that, we are more critical, not critical, I would say we are more, I think let's say the pessimistic or skeptical about Japanese industry's pricing power. We have done several analyses, but our main conclusion from our quantitative analysis of Japanese exporters' performance, Japan has long been relying on a model, export model, which actually try to keep the global market share as much as possible by not raising prices. So Japanese export prices for long time lower than import prices. And of course, the trade structure does matter because we import materials and parts, we export finished goods. But a point is that that strategy has made a secular deterioration types of trade. And again, right now, cyclically speaking, that deterioration terms of trade has been now exacerbated by yen depreciation. So structural problems tend to suggest that something wrong is going on in the Japanese economy, and yen's weakness reflects that to allow, at least, let's say like 20 yen to dollar. So that's the second point. The third point is the yen's weakness. What is the problem with yen's weakness? And we of course think that, as I pointed out, yen depreciation almost automatically deteriorates terms of trade, which is a loss of domestic income, obviously. So that is bad for the economy because I think that would be sort of leakage of income to the outside of the country. So terms of trade or terms of trade loss is of course damaging this country's, I think, the total wealth. But second point for this issue of the what is the negative consequences from yen's depreciation. The second one is related to fiscal sustainability. Japanese authorities remain fairly complacent with the risk of fiscal, I would say, not default, but big fiscal problem in Japan in the future. In our analysis, if the yen goes down below 150, Japan will probably get into a sort of vicious circle of yen depreciation and deterioration of the external balance, kind of non-stop the situation. So this is mainly because above 150 yen to dollar, it's a bit of the complex analysis, but I think the point is income surplus can no longer offset trade balance deterioration. So it means if exchange market looks at current account balance below 150 for the yen, that means deterioration of current account balance impacting yen on the weak side, and weak yen actually even making current account balance deteriorate, kind of the vicious circle. And of course the current account balance is very important macroeconomic data because that captures the net saving, net investment, or I think the over saving or the over investment kind of argument. So that will leading to a fiscal sustainability issue. So we tend to argue that leaving the yen fall below 150 is not a good idea because risk of the fiscal I don't say collapse, but I think the fiscal problem will increase quite significantly. So we are looking at those two negative impacts from yen depreciation. So finally, for the fourth point, so what the authority should do. And I tend to think that BOJ at least has to make a comment that yen depreciation is not necessarily good for Japan from the viewpoint of fiscal sustainability, and also BOJ has to make an argument that this weakness of currency does seem to reflect structural deterioration of the economy. So why don't we think about policy measures to strengthen the supply side of the economy. It's not an inflation story. Inflation story is very simple. Import inflation, CPI picks up, real income of people deteriorates. But that is the only small part of the problem. And I actually tend to criticize the BOJ in a sense that they're saying yen depreciation will be positive in net terms. Why? What is your logic? Their logic, simply speaking, income surplus would go up. However, income surplus is the income of Japanese residents, mean Japanese companies and banks, and that is the overseas income generated in the form of dividends, interest income, and maybe equity-related investment. But I think the point is returns. But the point is that reinvestment overseas has become really big. At least 1/3 of the income surplus is just reinvested outside continuously. So if companies make money outside the country, they continue to invest that money outside the country. They're not coming back. The Bank of Japan once argued that this income surplus should be coming back to Japan to boost capex, to boost compensation of employees. It could happen, but we have not yet seen any hard evidences. And unfortunately, that is not happening in my understanding, because foreign direct investment is not easy to be reversed. There should be a big cost for companies to shut down their factories outside the country and coming back. So I would say that this is the kind of sort of illusionary surplus of the country, not impacting much the domestic economy. Stimulus would be very limited. So negative side of the yen's weakness would be more, seems more obvious. So if I were a governor of the BOJ, I would say that we are very much concerned about this weakness of the currency. We have to take actions to strengthen the economy in collaboration with the government. So I'm really disappointed by the BOJ stance so far. Even if they could be happy this morning because of the yen start to appreciate, but please do not, I think, be misled by a temporary, appreciation of the currency, because that only reflects interest rate differential. So if interest differential is gone, yen cannot go back to 100. It can only go back to 120. And if the next cycle, U.S. rate hike cycle, is even more than the current cycle, yen could be 150, 160, and eventually the country will be getting stuck with a fiscal problem. So I stop here. So I'm not necessarily that interested in exchange rate and CPI dynamics of Japan. I stop here. Thank you.
Okay, thank you very much, Shirakawa-san. I think you made two interesting points, at least. One, you said that if the yen goes below 150, that sets off a vicious circle. And you pointed out that that the economic effect is very important. You also quantified, the first time I've heard this quantified, that the 20 yen to the dollar. That was the figure used, I think. I thought that was very interesting. Okay, for the benefit of anyone who's come in late, I should just explain. You see only two panelists on the podium today. You were promised three. Unfortunately, Jesper Cole, our third panelist, was taken ill during the night and is in hospital at the moment. We're waiting for news on exactly what's wrong with him. But so we apologise for there only being two panelists. But I'm sure we're going to make up in quality what we possibly lack in quantity now. And I turn now to our second panelist, who's Richard Katz, on my right. As I said earlier, he's a special correspondent for the weekly Toyo Keizai and a Carnegie Council Senior Fellow for the Asia Dialogues Programme. He's authored two books on Japan. One, Japan, the System That Went Sour, The Rise and Fall of the Japanese Economic Miracle, and Japanese Phoenix, The Long Road to Economic Revival. He's taught on Japan as an adjunct professor in economics at the State University of New York, at Stony Brook, and at New York University Stern School of Business. So, Richard, the floor is yours, please.
Hi, good morning. I'm really happy to be here. It's the first time in 3 years that I've been able to be in Japan because of COVID. And besides just being happy to be here, I'm really happy that I got through Haneda in 3 minutes. I've never gotten through an airport in less than a half hour to 45 minutes with the my SOS program. So that's all good news. I am very sorry to say that this session may be disappointing to you because I agree with Shirakawa-san for most of what he said, but I'm going to find a point of difference on the fiscal side, so at least you have some entertainment. If Jesper were here,
absolutely,
you see, he would explain why we're just a bunch of depressives and give us the upbeat, the silver lining in this cloud, a silver lining which is bigger than the cloud. And even though he might be wrong, he would be very interesting. and so he'd be wrong in an interesting way. Anyway, so let's start on the slides, if we can. All right, so let's hit the next one.
Next, please.
The next slide. Oh, there we go. So this is to say Shirakawa and I both agree that in the short term, the predominant dynamic governing the yen-dollar rate is the gap between U.S. and Japanese interest rates. Now, this is from July of 2021 until today. There's a 98% correlation. Almost nothing has a 98% correlation. This is extremely tightly bound. Now, you can hardly see it, but at the end, you'll see on the extreme right, just as U.S. interest rates dropped because of the consumer inflation numbers, so did the yen. And so I tried not to make forecasts, especially about the future. I have enough problems making forecasts about the past. But I would say for a while here, if you want to make a forecast on the yen, what you're really doing is making a forecast on the consumer inflation numbers and the Federal Reserve and the market reactions to that. So that's the short-term picture. If we could go to the next slide. The real yen, and this is where Shirakawa and I agree, the real yen, what is the real yen? It's the weakest it's been since the early 1970s. All right? This is a fundamental weakness. Now, what does the real yen mean? The real yen is you take Japan's trade with all of its trading partners and you weigh how much they are. And then you compare rates of inflation and deflation in Japan compared to everybody else. So that, the price the price of a shirt or the price of the car is kind of equalized. What would that rate be? And that gives a sense of the real competitive power of Japanese exports on the one hand, and the real cost of imports that people have to pay for energy, food, iPhones, whatever, on the other hand. So a weak yen means you have to basically, instead of giving one Toyota for every ship full of wheat, you've got to give 2 Toyotas for every ship full of wheat. That's great for Toyota, but not for the people who want to eat bread. All right? So that is incredible. So let's move to the next slide, if we may. Now, here's the thing. we always have this period, this correlation between the yen-dollar rate and the gap between U.S. and Japan interest rates. The top line of those squares and the trend line there is what did that look like in the 12 years, 2001 to 2013, before the Abenomics and Kuroda, right? So there's a very clear, tight correlation there. But you see that trend line and the bottom one below it is the last year and a half. So they both relate to it, but you see there's been a leap downwards. And that leap downwards between what's the sort of equilibrium rate of the yen, whether interest rates go up and down, then a decade ago, or 2 decades ago almost, and now, what you see is that equilibrium rate has dropped by 20 points. So not only does Shirakawa and I agree on the process, we've actually got the same number, 20 points. So there you go. So we must be right, because the two of us say the same thing, so it's got to be right, I'm sure.
Without speaking before the session, right?
No, we did not. No, there was no conspiracy here. The only conspiracy was Anthony Rowley talking to the Department of Commerce to make the CPI numbers be lower so we could have a more interesting session. Okay, so, and I think most everybody, correct me if I'm wrong, but my sense from reading the commentaries by Japanese economists and traders and stuff is that everybody, except the BOJ, agrees that the yen rate is not simply an interest rate phenomenon, but a reflection of a fundamental weakening of the Japanese economy, and that it is bad for Japan. All right? The BOJ says the opposite, and that's for, in my view, political reasons that we'll get to in a minute. So let's go to the next slide. Okay, so supposedly a weaker yen is supposed to let you export more, right? You can sell your Toyotas and Camrys, whatever, at a lower price, and you pay more for imports, so people should want to buy a domestically produced good instead of an import. So if the yen is weaker, we should expect an improvement in the trade balance. And in fact, we don't see that. What we see is that in these years from 1994 to about 2013, I cut it off because I gave Kuroda's policy, say, a year to have an impact. That the real yen, which I showed you before, the real yen compared to other countries, it was at 106. It's an index figure. It's not like the yen-dollar figure. It's like the average for the whole half century is 100. So this is an index. And on average, the trade surplus was 1.2% of GDP. All right? Now, in the years from 2014 onward, the real yen was 74 points lower. So that's a lot lower, right? It's 25% lower. That's a big drop. And yet, instead of the trade balance going up, it worsened. So there was an average trade deficit of about 0.3% of GDP. That's not a huge number, but the swing from 1.2% of GDP to minus 0.3, that's 1.5% of GDP. So if you're expecting to have an export-driven growth, you have lost that source of growth. Right? So the yen is not doing what it should, the weaker yen is not doing what it should do, and the reason it's not doing what it should do is that Japanese companies are less competitive than they used to be. That's the fundamental problem. If we can go to the next slide. Okay, so let's look at electronics. I mean, there's a very, the Japanese electronics industry was, along with autos, one of the real superstars on the export market, on the global market. And we can see, this is compared to the year 2000 to 2018, right? So this is in trillion yen. So we can see that exports, first of all, the amount of exports dropped from 15 to, I can't even see. I guess I need new glasses. 10.
Can you?
Oh, I've got my own thing. Here you go. I have new glasses coming, but they've not arrived yet. Okay. So it's dropped from 14 trillion yen to 10 trillion. That's a big drop. This is the annual numbers, right? And on the other hand, imports rose from 7 to 11. It's a big rise. And here's an industry that used to be always running a trade surplus, and now it's running chronically a trade deficit. Now, I don't have a chart for this, but you might think, well, this is because Japanese companies are going offshore, and these Japanese companies are still doing a bang-up job. That's not the case. If you look at the global sales, from wherever it's produced, it could be produced in Malaysia, Thailand, Europe, wherever, but the global sales of Japanese electronics companies, the top 10 companies between 2008 and 2018, at a point where global sales of electronics were zooming, every single one of the top 10 Japanese electronics hardware manufacturers had a drop in global sales. And that's because where is the Sony tablet, the Sony iPhone, the Sony laptop, the Sony whatever else, right? This is a company that year after year after year put out must-have products, right? Tremendously inventive. And now, instead of being a superb company, it's just merely good. And in a rapidly moving technological thing like electronics, merely good or even excellent is not good enough. You've got to be superb. It's very hard for the same company to be superb for decade after decade after decade. Now, in autos, Japan does well, but again, more and more is going offshore. So weaker yen doesn't really help them in that regard. So the point is that behind these financial numbers is as Shirakawa also said, is a fundamental weakening of the competitiveness of Japanese companies, whether based in Japan or based overseas. Okay, if we could go to the next one. Now, the question is what then, we've talked about the causes of the weak yen, what's the consequences? Now, the BOJ has been insisting that a weak yen is good for Japan. Now, I don't know if the BOJ believes its own story or not. Maybe they do, maybe they don't. They would like it to be the story. Here's why. If a lot of the weakness of the yen is being caused by the interest rate differential, then people are saying to the BOJ, why don't you raise interest rates? Well, if the U.S. rates are at 5%, they're certainly not going to go from basically 0 to 2% or 1%. So even if they raised them a bit, that wouldn't make any difference. And besides, Kuroda is correct that the majority of Japan's inflation, which is what this chart will tell you, is really cost-push inflation imported from overseas. It's not like the U.S., where it's demand pull, where there's so much excess demand, people have so much money to spend, that's what's causing inflation. This is, the cost of things Japan imports are going up. So 90% between 2012, just before Kuroda came in, and today, 90% of the total increase in prices over that period of time was in the import-intensive food and energy sectors. And if you look at and you'll see in the last couple of years, that's the dark black line on top, it really zoomed because of the weakening of the yen. The gray line, you can see over this period of a decade of 10 years, there was only a 2% rise in the entire rest of consumer prices. Now, I believe, if I'm not mistaken, Governor Kuroda promised in 2012 or 2013 that he would reach rate of inflation of core inflation of 2% inflation every year, and he would achieve it in only 2 years. Now it's been a decade, and it's been not 2% per year, but 2% per decade. Something is not working. And yet, there's a dilemma if you're the Bank of Japan. If the economy is weak, and if the US and Europe are facing recession, and I'm not going to predict whether they are or not or how severe, but if they are, to sort of raise interest rates in that situation, if nothing else is done, and I would suggest something else could be done, we can get to that in the discussion period, then that weakens the economy. So there's the real dilemma. What's worse? The honest thing would be to say, the weakening yen is negative, cost-push inflation is also negative, which is least negative. But instead, it's politically better, I think, from his standpoint to say, well, this weak yen is good. Now he doesn't say it. Now he sort of says, a one-sided movement, blah, 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 is not so good. But, you know, the point is this is hurting the Japanese economy. Now let's move on. We'll see how badly it's hurting the Japanese economy. This is real consumer spending. Since 2000, now you can see it was going up, up, up. And since 2014, when you had both the consumption tax, which was a hit to real consumer income, and you had the weakening of the yen, consumer spending has never gotten back to where it was in 2014. I don't believe there's any previous period in post-war Japanese history where consumer spending was that flat for that long. And the reason for that is that Japanese real wages have been stagnant and at times even negative for years and years and years. And the government made it even more negative by transferring income from households to companies. They lowered taxes on companies. They raised taxes on consumers. Now, if people have less money to spend, they're not going to spend. The finance ministry will tell you they're not spending because they're penny pinching, they're afraid to spend, they're worried about the deficit. It's all nonsense. The savings rate in Japan has really gone down. Japanese now save less than Americans. Can you imagine? Saving less than Americans. Because their income has gone down. So of course they're not spending. And then of course then COVID was another hit. So that's, and the rise of prices because of the yen weakness caused inflation is adding to the depression of real consumer income and further weakening their ability to spend. Okay, if we could move to the next slide. Now, the theory, the trickle-down theory of the Japanese government since at least 2000, did not begin with Abenomics, but it's been consistent, is that if we put more money into the hands of the corporations by cutting their corporate profits and by weakening the yen, which helps the giants, as I'll explain in a second, then they're going to turn around and pay higher wages, and they're going to invest more. And Japan will be very attractive to foreigners who will want to come here. Okay. And Japanese companies won't go offshore as much. None of that came true. What we see is this is beginning in 1994, that even though the Japanese corporate profits and cash flow keep zooming, they're higher and higher and higher than ever, the net capacity, real capacity of plants, factories, offices, stores, machinery, all that stuff by private corporations is basically no higher today than it was almost a quarter of a century ago. Can you imagine? They are not expanding their capacity. And in certain industries, if you're selling less cars domestically, why would you build new car plants? If you're meeting overseas markets by building factories overseas instead of exporting, why would you build a new factory here? So all that's happened is that the money that the companies have has risen in cash and paper assets, which lie fallow. They don't do the economy any good. In fact, they withdraw purchasing power from the economy. And why you give tax cuts to people who aren't going to use them well, I don't know, except for lobbying power. But the fact is that's another fundamental weakness, which means they're also not modernizing enough. They don't use digital technology very well. They come in out of 64 countries, 53rd Japanese companies, and how much benefit they get from every dollar of investment in digital technology. All right? So that's a problem. All right? So you're wasting this money. And as a result, someone's got to buy all the goods and services, so the government keeps running deficits. The deficit is not the cause of Japan's economic problems, it's a reflection of their economic problems. Okay, if we could do the next one. And the thing is that the theory is if you lower the yen rate, that will increase your real trade surplus, adjusted for prices, your real contribution to the economy. And what we see is that back in 2002 to 2013, on average, an improvement in the trade balance added 0.1%, 0.1% to GDP. That's almost like a rounding error. It's nice, you know, but it really is nothing to shout home about. Now we have a much weaker yen, and it's still adding 0.1% to GDP from what it otherwise would be. So basically, Japan has lowered its purchasing power and gotten no benefit in real growth, right? So one final thing I would want to say about the impact of this. It is clear cut that if Japan is paying more for everything it imports and having to export more, so paying more for barrels of oil and for wheat and all the other items it has, that is a transfer of income from Japanese households to foreign producers. Okay, that's straightforward. I think what a lot of people don't realize is that indirectly it's also a transfer of income from Japanese households to Japanese multinational companies. So Japanese households have a decrease in their real income, their living standards. Meanwhile, the Japanese multinationals are raking in money because they can either charge higher prices for their exports, or if they leave the prices the same, they get more yen. And then their investments overseas, when translated into, they get more yen. So you're really transferring income from Japanese households to Japanese corporations, which is what the Japanese government has been doing for at least 20 years in all sorts of ways, and the weaker yen is another way of doing it. And I believe that's my last slide. Let's check. Is there a next one? Okay, no, there's not. Just to add one tiny bit of entertainment, I do think in the long run that, yes, if Japan's current account surplus goes negative, then there are very serious implications for the fiscal picture, although Japan's got tons of reserves, so it may take a long time. So even if the yen were at 160, I think the consequences for the fiscal side are nothing we're going to see anytime soon. And people have been predicting, a Japan government bond crisis and fiscal crisis forever. The Ministry of Finance has been predicting it since 1975, and it hasn't come. And so I think that is something, it's a long-term problem to pay attention to. I don't think it's an immediate danger. And I throw that in only so we can have at least one point of disagreement.
Okay, thank you very much. I think the best word to, or best phrase to describe today's presentations are eye-opening, especially about the points about the fundamental weakness in the Japanese yen. Before I open the floor to questions, let me just ask both of you, if I can, a quick question. How much do you read into yesterday's figures on the US inflation? Is this really marking a turning point, and are we going to see lower increments of inflation from here on or not? And the second point is, obviously the structural problems in the Japanese economy, which you've both pointed to, are going to take quite a long time to change. So in the meantime, what would you say was an optimum level for the yen? Presumably not 150. Is it, if you might take off 20 yen, is it 130? So Shirakawa-san, please, first.
Okay. For a U.S. inflation outlook, I think we know that the goods prices are peaking, and year-by-year change of goods part of or commodity part of CPI very much likely to shrink its year-by-year positive margin. Of course, the focus is on services prices, including house rent. And for services, I think the services prices, the focus would be on wage growth and tightness of labor markets. And we tend to think that US CPI would continue to soften in terms of year-by-year change into next year or even year after. However, at which level US CPI would be stabilizing in terms of year-by-year change? Is that, of course, it's not 7%, not 6%, not 5%, but possibly between 3% and 4%, which is still higher than the Fed 2% inflation target. So in our view, maybe next year on average CPI will be 4.5%, Of course, much lower than the current level, but still it's not something which what we expect, like going down to 2% quickly to the end of next year. And Federal Reserve, the projection for which is not CPI, PC deflator, year-over-year change in fourth quarter next year is 2.8%. So maybe if it's translated into CPI, 3.5% in Q4 next year. That number seems okay. Okay means maybe that kind of level, but could be somewhat higher. It depends on the dynamics of wage and rent. And we very much not concerned, but interested in whether or not the labor market conditions get looser from here. We have still very high level of the job offers in the U.S. and as Lawrence Summers has argued, unemployment rate is not necessarily a good indicator for wage growth. So there remains a big gap between number of job offered and number of unemployed. So still like 5 million gap. So wage growth would not easily go down, underpinning CPI inflation. So market reaction yesterday, I would say it's kind of the market is a market, but overreaction. And I think the Fed cannot easily, cut interest rates because of that services inflation. On the second question of the yen optimal, I don't know. I mean, our analysis suggests that without structural issues, structural problems, I think the yen would be like 120, 125. But because of structural problems, I think now 140, 145-ish number. So optimal would mean not so deflation, not so inflationary, not leading to the fiscal risk. Our sense is maybe between 110, 130, 120-ish number. Okay. Go back to 100 would be a bit too much, maybe too deflationary. But we tend to favor like 120 yen to dollar. But I think I would say that again, even if the U.S. start to cut interest rates, it would not be the case, where Japan would go. I mean, would see like 100 yen to dollar. So might be good for Japanese, policymakers to see yen to appreciate back to 120-ish level if the U.S. starts to cut interest rate. But I think it will take time. So maybe somewhat below optimal level of the yen, I mean 130, 140, would continue into the at least middle of next year. Okay. I stop here.
Thank you very much.
Thank you. Yeah, the market is very manic depressive. Here's the good news. The good news is that, unlike Japan and unlike Europe, the U.S. inflation is almost entirely this demand pull inflation. The reason that's good news is because we actually know how to deal with that. Clearly, we don't know how to solve deflation very well. It's very hard. But inflation, we've got it down. And so we know the Federal Reserve policy, which is to raise interest rates in order to slow the economy, that's going to do the trick. What nobody knows, including Jerome Powell, nobody knows is how much do we have to slow it down? Are we going to tumble into recession? If so, how severe? How stubborn is the labor market and keep hiring people and pushing up wages? So how high do interest rates have to go in order to finally crack it? Now, what the market read into this significant drop in inflation is, this means that unlike a month ago when Jerome Powell said, looks like we're going to have to raise interest rates higher than we previously thought, the market is now saying, maybe they don't have to raise interest rates as much as they thought a month ago. Exactly. Personally, I would feel happier if I saw 3 months in a row where something really interesting happened, or at least 3 out of 4, something like that. So I have no idea what it means in terms of the long term, but but the market reacted as if, maybe, and so Jerome Powell is erring on the side of, I better do too much restraint rather than too little, so this doesn't get out of hand. I have no idea what the optimum yen rate is. What I will tell you this, it seems to me that the policy mix is wrong in Japan, and this is one of the problems, that you are counting on zero interest rates for a quarter of a century to keep the economy afloat. What is the cost of doing that? Supposedly the zombie problem is over, the bad debt problem is over. 35% of all loans charge less than 0.5% interest rate. 16% of them charge less than 0.25%. Now, I am not sure 0.25% is even enough to pay the electric bill for all the computers that are going to count the money. But regional banks particularly are in trouble. So you're keeping zombies alive. So it doesn't look like a banking crisis. What it looks like is a deterioration of the overall economy, the slow corrosion that we agree upon, and the monetary policy is part of it. So what I would do is have not this stop-go fiscal stimulus that often is wasted on on less than optimal stuff. For example, look, Japan needs to have a genuine green revolution, not in wheat, but a green revolution in fighting climate change. McKinsey's estimates that the amount it would have to invest in the transmission lines to the solar and wind power farms, the battery storage, this, that, the other thing, the mitigation against floods, $12 trillion yen per year for the next 30 years to try to hit net zero in 2050. Now, the actual annual rate is now of investment about 80 trillion. So 12 trillion is a significant bump upward. And that would be a combination of both fiscal stuff and private stuff for which you'd give incentives. There's all kinds of really interesting stuff you could do. So if you did, also, frankly, it's not going to happen, but personally, I would raise the corporate tax, which they may do, or for defense spending, and actually temporarily roll back some of the consumption tax. I would do other sorts of things. But get money into the hands of people, have them spend, have corporations investing on ways that improve the long-term productivity of the economy, and that would give you room to raise interest rates without causing the economy to crash. I don't see that happening, but if I were God, that's what I would do.
And the yen rate?
I have no idea what an optimal yen rate is. That's above my pay grade.
Okay, all right. Do we have questions from the room, please? Because, yes, there's over there, please. Come to the microphone as usual and give your name and affiliation. Thank you.
Thank you for.
It's not on.
No, thank you for.
Still not on.
Patrick Welte, Frankfurter Allgemeine Zeitung. Thank you for the presentation. This is not on, is it? No.
There should be a switch there. It's on.
It's on? Okay, sorry.
Yeah.
So, two questions, if I may. One is, maybe the fundamental question, why is there no fiscal crisis in Japan for such a long time, even if everybody talks about this? What are your explanations for that? Second question, when you talk about loss of productivity, what to do against it? Mr. Katz, you just mentioned a little bit by BOJ policy, but it seems to me, 0.0 or negative interest rates is going to raise new zombies. So is that the problem? Should the solution be that Bank of Japan really starts raising rates? And what would that mean for the economy instead of looking again at the fiscal policy?
Sure.
Okay, question addressed to both panelists. Shirakawa first, please.
Okay. The main reason why fiscal or collapse hasn't happened yet is, simply speaking, Japanese, right now corporations have accumulated savings. In households, as I think Mr. Katz pointed out, I think the saving rate has come down a lot, but still they are saving. So this is a way that Japanese authorities do. fiscal situation will be really bad. You have to have this money, and pension may be collapsing in the future. You should save, and we save. And that's why they have been able to sort of delay the time when fiscal shock happens to the economy. So it's not, I would say, this kind of bluff to people. So just, it's kind of campaigning the risk. And VAT has to be raised to like 35%, a 30% kind of argument we have heard many times from Ministry of Finance. And also there was interesting argument done by one of the Ministry of Welfare guys, that is, when you retire, you have to at least have 10 million yen. It's not a big number. 10 or 50 million yen at least. But that is a shock to average Japanese because they don't have such kind of savings. So authorities have promoted company to save money. Shock could happen. You're gonna have a disaster situation in the future. You should save money. You have to have a cushion money and so forth. And because Japanese households still, as Mr. Katz said, showed at the chart, I think consumption has been quite weak. Companies always tend to think, okay, we have to have some buffer, precautionary savings. And relating to the second question, because of that, in understanding, the innovative investment has been too small and impacting productivity. So one thing, of course, I totally agree with his argument about the zombie companies still surviving, but plus the continuous reduction of capital expenditure has been, I think, negatively contributing to productivity. And also, in our understanding, the biggest problem right now we have in Japan is the remaining quite rigid employment system. In my understanding, U.S. economy's dynamics mainly stems from much more flexible employment or job markets. Look at the reaction of the job unemployment rate to the COVID shock. Skyrocketed, right? And then down. Look at Japan's number. 3%, now 2.7%. I think the very, small movement of the unemployment rate, maybe government subsidy and so forth. But the point is, Japanese firms have been unable to fire people, in particular full-time regular employees. Because of that, if you compare the volatility of corporate profitability, Japanese corporate profit volatility is the 3 times as big as the US corporate profitability. Why? Because if shock happens, Japanese corporate profits down a lot. Why? Because they have a sort of fixed cost of employment or personnel costs. That would damage their proactive, innovative investment in our understanding. So how to fix the fundamental problem of Japan? We kind of reached a kind of conclusion that is, we have to make Japanese job markets to be much more flexible. Hiring has to be done much more easily. And for that, labor law amendment would be needed. But that, I think, would not happen quite soon. I think they taking a long time. But I think that labor issue or the mobility, liquidity issue of the labor markets is really contributing, in our understanding, decline in productivity. So labor markets are key.
Sorry, Richard.
Yeah, I think there hasn't been a fiscal crisis because there's really no reason for a fiscal crisis. The there is a fiscal problem, but it manifests itself in a very different way than the sort of this explosive, Japan government bond market crash. So, yeah, there's a lot of debt in Japan. But first of all, you've got to look at the net debt, because a lot of the numbers people use is gross debt. And so if the Bank of Japan owns government bonds, that's not going to cause a crisis because they're not going to sell them. So you have to look at the private holders of it. Now, when does a debt crisis come? A debt crisis comes when the government has a difficulty paying the interest bill on it. And that causes interest rates to go up even more because people are afraid of not getting paid, and there's a spiral. In the Euro debt crisis, every single country that was in crisis had both a budget debt crisis and a balance of payments crisis. There was both foreign debt and domestic. Countries that had a big budget problem but not a balance of payments problems, they didn't have a crisis, right? Now, Japan is one of those countries. So, but if you're having zero interest rates for a quarter of a century or near zero, then the interest bill of the government is actually lower today as a share of GDP than it was in 1986, partly because the BOJ has kept the rates down. BOJ can't produce inflation at will, but can certainly keep interest rates down. It's got that power. And now, under Kuroda, the Bank of Japan has bought so many bonds that the total holdings of government bonds by private investors is less today than it was when he came in power. So if we weren't going to have a crisis in 1986 and 2012, we sure as hell are not going to have a crisis in 2022. Now, does that mean there's not a problem? No. It means the way the problem manifests itself is in this constant pressure to keep interest rates at the floor in order to avoid such a crisis, and therefore all the consequences for the economy, like keeping zombies alive, and other sorts of things. And also, people being unable to accumulate savings because they're not getting compound interest. And so they would have to save more every year just to reach that 10 trillion yen goal. So doesn't mean there's not a fiscal sustainability issue. It means, in my view, that it does not manifest itself as a crash in the bond market. It manifests itself as slow, grinding corrosion of the economy, one of whose symptoms is the weak yen. So that's my view. Now, on the productivity, see, who produces productivity? Companies produce productivity. What matters is, Japanese government and Japanese companies think what matters for growth is how much you invest. No, that's part of it. But what really matters in a mature economy is not how much you invest as much as how much benefit do you get from what you invest. The Japanese companies invest a truckload of money, actually, 10 shiploads of money in digital technology. They use it very poorly. What they do is they use it to cut costs rather than coming up with new processes, new innovations. As I mentioned earlier, 53rd out of 64 countries in what's called business agility, how much benefit you get from these investments in what's called knowledge-intensive capital. Now, what's the cause of that? Economies grow fast when you have a lot of competition. Competition, not economies of scale, for a mature economy is the more powerful driving force. In sectors of the Japanese economy where there's more domestic competition among companies and market share changes and market leadership ranking changes and new companies can enter, those sectors are much more productive. The less competition, the less ability of a new company to enter and displace the old ones. Like, where's the Japanese Tesla that forces the incumbents to change their game on EVs? Where are the pioneers? There are signs of that happening, and I've got a book coming out next year, shameful advertising, but there you go, about this, the positive signs. So what you need is more competition will drive productivity, more inward foreign direct investment. In 2019, out of the total stock of foreign inward direct investment in factories, shops, software companies, whatever, as a share of GDP, out of 196 countries, Japan came in 196th, just behind North Korea, which is getting money from China. All right? So this is a problem. Things that new ideas, new blood, new companies that can overthrow old companies the way that Microsoft and Intel overthrew IBM. To me, that's the secret to productivity. One other quick point. While all these zombies are being preserved, there are hundreds of thousands of profitable SMEs in Japan with a few millions of employees who are going out of business only because the owner, CEO, is 70 years old or 75 years old or 68 years old, and his children do not want to take over the business. And with generational change, when they don't want to take over the business, they say no, unlike 30 years ago. So why can't they get somebody else? Because the banks have this personal guarantee system. You can't get a loan, from this company unless you agree to, if the company fails, you have to give up your house, your car, your life insurance policy, your firstborn child, right? And so I know of cases where they were people who could take over a company, don't do it because they can't take on the personal guarantee. And so that is so what's going on is that while zombies are being preserved, healthy, profitable companies that could be even better are dying. And of course, that lowers the overall. If your less productive companies are being preserved and your more productive companies are going out of business, of course your productivity suffers. The financial system, I agree with you about the labor system, rigidity, absolutely. But I think also the financial system is one of the biggest blockages to Japanese revival.
Interesting point. Okay, there's a question been sitting here online for some time, so I better come to this. It's from Daniel Maggs. It's addressed to both panelists. I'm not quite sure what Daniel Maggs' affiliation is, but quite a long question. He says, and I quote, "A major reason why Japanese competitiveness has declined is that the new generation of hardware devices requires highly sophisticated software. Traditionally, Japanese companies have seen tangible hardware as superior to intangible software. Software engineering is generally a low-paid career, outsourced to contractors, in the same way as digital design. It is changing, but not fast enough. As a result, many Japanese companies are leaders in parts of other companies' supply chains rather than product leaders like Apple." So his question coming to this is, what does the Japanese savings rate look like when you exclude retirees? Sorry, that doesn't seem
I
quite...
don't see the connection, but okay.
Well, I'm not quite sure whether those both address... The explanation doesn't seem to quite fit the question, but anyway, comments. Do you have a comment? Or
Well, first of all, on the software thing, the question is absolutely right. Japan has got about, I think it's number something like 300,000 to 400,000 fewer software engineers than the country needs, and that is going to grow. So it's actually having to do offshoring, hiring offshore software programmers. And it's very interesting. First of all, people are talking, the government always looks for the shiny object. Let's train people in artificial intelligence. Well, but you got to walk before you can run. Or cryptocurrencies, or fintech, or nanotechnology. The basics. Get people to know, how does a company use the cloud to improve its sales, to develop new products, that sort of thing. So there's a new company called Monstar. It's one of these glorious new startups. What they do is companies, big and medium and small, hire them to do a software project. They've got 1,000 software engineers, maybe they've got more now, this was 2 or 3 years ago when I spoke to them, overseas. And then they train these people. They also bring them to Japan to learn Japanese so they can speak to the clients. And so they do on contract this software work. There needs to be more consultants who can teach small companies who don't use digital technology because they have no idea how it would benefit them. You need some of these consultants, the Europeans do this, who can sort of teach them. So, yeah, so I agree with the question, and there are answers, but it's a difficult problem. You're not going to suddenly create all these software engineers overnight, and particularly if you're training them in crypto and whatever. They don't even have a test. Teachers don't teach digital skills because it's not on the university entrance exam. So why teach it? Now, retirees.
Retirees.
Well, you know what? If you look at the savings rate, right? so the vast majority of the savings are held by elderly people, because frankly, if you're 65, you have no idea if you're going to live to 75 or 80 or 100. I mean, God forbid you should live to 100, because you're going to starve to death if you run out of savings. So you can't spend as much as, if you knew when you would die, then you could really, plan, but you don't know. So people hold on to it. But I'm talking about, if you look at the annual savings rate, how much of their income do they put away? The people under retirement age are saving less and less and less of their income per year. It was like 11% in the 90s. Now it's about 2 or 3% overall. And the older people are just saving, but they're doing so they're not drawing down as much as they otherwise would. And again, if you're not earning any interest and the pension funds or the life insurance annuities are not paying off, then you won't, you really sort of hold on. Could I make one more point on this? I think.
Okay, please do. Yeah.
Yeah. Listen, I think one of the things is the Japanese have all this money in life insurance and savings and not in the stock market. Now, I think it's rational not to go into a stock market that doubles and halves every few years and you're dependent on capital gains. On the other hand, here are these companies that are raking in cash. So what if you had your tax system that favored dividends instead of having dividends and capital gains be equal? And that had a graduated rate, not a flat 20% rate, but depending on your income, no dividend tax higher than your actual income tax, perhaps even lower, up to a certain, perhaps zero to a certain amount. Then you could have investment trusts that are focused on high dividend stocks. And people could invest in that as if it were a bank. Except it has some risk to it. It's not risk-free, but God, if it's diversified, these companies are earning oodles of money. And then that would put more pressure on the companies to spend some of this cash, not in stock buybacks and not in capital gains, or plowing it when they can't do it in securities, but actually distribute it to the population in the form of dividends, which would give these people more money to spend, make them feel more financially secure, et cetera. This is something that could be done at the stroke of a pen. You can imagine the circles in which there's resistance to this notion. And there's other things that would have to be done to make it work, not churn and burn, et cetera. But point is, there are creative ideas that brilliant people in Japan know. The problem is not lack of good ideas. The problem is the political process to actually get them implemented.
Yeah.
Sorry if I'm too passionate. But
Interesting point. Shirakawa-san, either of those points do you want to comment on, the competitiveness and the savings rate?
Well, the saving rate, not a saving in terms of stock. Therefore, saving rate for working generation up to 64 years old, somewhat distorted by the huge cash payout by the government in 2020. So maybe up to 19, on average, maybe around 5% plus. But that accounts for, roughly speaking, 70% of the total population. And above 65, like pensioners, saving rate should be negative on average. Maybe like 2% negative kind of number. It's not necessarily huge negative. So on average, savings rate, including pensioners, like 3%, but plus 5, minus 2, 3 kind of balance. But again, as Mr. Katz pointed out, I think the point is pensioners' savings rate has been underpinned by their fears about they don't know uncertainty about their expectancy about their how they're gonna live from here. Yeah. So, but again, we economists, Japanese economists, tended, in the past, back in maybe 10 years ago, we kind of overestimated the pace of decline of savings rate of the household. And we actually expected the current account balance turning into deficit even much earlier than actual the performance of the current account balance. So I would say that the pensioners' saving rate decline in terms of pace has been slower than our expectation, and they have become more worried about the future, or COVID affected their saving consumption behavior. But our point is the slower than expected decline in savings rate. That might be helpful for the government and finance. Yeah.
Okay. Do we have any more questions from the floor, from the room or online? I have a question I'd like to put, which is.
No.
Oh, sorry. Were you raising your hand? Yes. Go ahead again.
Patrick Welter once again. Once again, one of these very general questions. No, it's not really general, but if you talk to people in Europe, they talk about Japanification. They tell you this is a country, declining population, declining productivity, there is no way out. It doesn't seem, when you're listening to you, that you see this is a consistent argument. So what is your position on this point of Japanification? Is this the dilemma every aging country is getting into, or is there a way out? And what about Japan?
Go ahead.
Sorry, you're nodding.
I don't think we have any easy way out. So please take this happening in Europe as well. I mean, the Japanification would be the case for not all European countries, of course, but I mean, demographics does matter, and some the link between demographics and productivity, competitiveness. So I'm very pessimistic about the trend growth in Europe as well. And way out, I think. Many things have to be done, but too many things have to be done. And I would say I'm quite pessimistic. Any partisan can resolve this, kind of problem. So one way to do is to increase population. So maybe immigrants, I don't know, but I'm very pessimistic. But as I said, point is should we be prepared for some unwanted, disastrous kind of end game, like fiscal collapse, or we're just seeing a contractionary equilibrium, so shrinking population, shrinking economy, that is getting bigger, but would be okay somehow. So that's a big issue, big question, and we have become more or less confident about the stable contractionary equilibrium, less confident about that. We have become not necessarily so confident of the crash, but risk of the economy getting into a sort of collapse or crash, we tend to think has picked up. And our view is too late. Sorry, but it would come. I don't know when, but almost impossible to escape. Very difficult. So that's why at the beginning I pointed out that central bank job is not necessarily only to tackle inflation. They have to argue that many things have to be done.
Yeah.
And our job is, of course, to contain inflation or achieve price stability. Mm-hmm. But in the meantime, they have to think about the backgrounds of this yen's weakness. What is the cause of yen's depreciation? It's a kind of sign of the market is now signaling or making warning that economy is now getting into a sort of fairly difficult situation.
Okay.
So that is my current view. So I'm quite pessimistic.
At this point, we need Jesper Cole, who calls himself Japan optimist.
I will be the semi-Cole.
Okay, you'll be the semi-Cole.
So I thank you finally saying something I can strongly disagree with.
Okay.
We sort of planned it. It got too boring. He would say something he didn't really believe because we just had this discussion. People have been predicting, this inevitable soon collapse again and again and again in Japan, and it hasn't happened. And I remember in 2003, and in the beginning of the year, the JGB was going to crash. And at the end of the year, the stock market was rising tremendously. In between, did some very interesting things to help resolve the banking crisis, set it in motion. Two economists whom I respect greatly predicted in 2012 that by 2021 and 2022, the JG market would collapse because the total amount of government debt would be more than the total amount of personal assets, and boom, mechanistic. I don't think it works that way. I think the danger for Japan is not falling off a sudden cliff. I think it's walking more and more and more into the ocean, slowly, as it corrodes.
Is that a consolation?
Now, I don't know if that's good or bad, but it's the way I see it occurring. And on the other hand, what I really disagree with is the idea of no way to avoid it. Yeah, there's lots of ways to avoid it. Lots of ways to avoid it. There are things that could be done. For example, if Abenomics would have been nice had it actually been implemented. But none of the arrows work without the other two. And he only did one arrow, monetary. I think if Kishida's new capitalism, which is really not new at all, but anyway, it's old revival of stuff that Japan used to do. It's high growth era capitalism. If Kishida actually implemented what he says he wants to do, that would do great things to promoting startups, dealing with the income distribution. This would help a great deal. The problem is, I talked to bureaucrats who had these bureaucrats and business advisors and academics who came up with these tremendous report showing what all the obstacles were to more entrepreneurship in Japan and therefore higher productivity growth and innovation. But there were no solutions in the report. And I said, well, where are the solutions? And they said, we were not allowed by the Prime Minister's office to put them in because the ministries would disagree with each other, and we didn't want the public to be aware ahead of the upper house election that they disagreed. Now, they say they're going to come out with a 5-year plan before the end of the year. I've been talking to people about it. That will surely do something, but I think we're going to be disappointed, or at least I will. Some people in certain ministries will be happy, I guess. But there is nothing inevitable about this. The thing about Japan, the tragedy of Japan, in my view, is that the whole is less than the sum of the parts. There's so many brilliant, smart, creative Japanese who are trapped in very rigid institutions. The problem is institutional sclerosis, not Japanese culture, not something that's impossible to resolve. So I think all of these issues, these productivity issues, et cetera, are difficult, not easy to solve, and the smart money would probably bet Japan won't solve them because it hasn't. But I vote for hope over experience. Certainly, it could be done. Whether it will or not, I don't know. But to say it can't be staved off, we're going to have this crisis, I just don't buy it. Sorry.
All right, Shirakawa-san, I can see you're eager to come back in on that.
Probably a bit of the misunderstanding my statement. I think I'm not necessarily expecting the collapse happening soon, and the chances for the gradual contraction or contractional equilibrium type of path would be more likely than collapse. However, chances for a collapse has picked up in my understanding. So I'm not saying the economy is getting into a collapse soon, but I think chances seem to somewhat become higher.
What do you mean by a contractionary equilibrium?
So kind of stable, as you mentioned. I think you're exactly what you said. Gradual
decline.
But you don't mean negative growth, or do you? Negative per capita growth.
The potential GDP growth rate would, right now in our estimate, 0.1% plus.
You say 0.1.
Well, yeah, but in 5 years' time, going down to minus 0.2%.
And per capita?
Per capita, I think slightly positive still.
Okay.
Could I?
Okay.
Yeah. But I think
I think that's fair.
And also I don't think I'm not saying that the unavoidable, but the point is I think the actual implementation of right policies would not be done. Okay. We know what we should do, but in reality, that would not happen.
Could I make a quick comment about Europe,
Quick,
since it was
because
asked?
we're coming
Very
up
quick.
on time,
I think Europe's problems are very different. Like Tolstoy said, all economies in trouble are in trouble in a different way. I believe that's what he said. And in Europe, I think it is, if you look at the company level and the productivity of companies and innovation, et cetera, Europe is doing much, I mean, the different parts, but I mean, on average, it's doing much, much better in Japan. The problem, in my view, in Europe is horribly destructive macroeconomic policies that have created poor growth where it need not have occurred. So I think, and those problems are actually easier to solve than Japan's problems.
Okay. I would like to get in one quick question before we close, and that is, do we have a capital flight problem in Japan as a result of the differential interest rates? For example, pension funds and other institutional investors are buying huge amounts of foreign bonds and so on. And one argument is that this money is going overseas. If it were coming back into Japan, it could be invested more and this would raise productivity and so on. Do you buy that argument? Richard, you go.
No. We have time for a sentence or two?
You've got 3 minutes at least.
Listen, if Japan is accumulating all these savings that it's not investing, then to invest it overseas where you earn better income would be a better deal for the Japanese household. Life insurance, banks, et cetera, invested overseas, earn stuff, companies, and then they pay higher dividends, interest rate, whatever, to the households. So that's not a bad thing. Japan's reserves are so gigantic, and its current account will remain in surplus for I don't know how long. No, a European-style sort of debt capital flight like we had in 2010, I don't see that at all until the point comes when Japan runs a current account every year, and its huge amount of savings are really, really dropped down. That's going to be a long time down the road. That's a real danger, but not in the next 10, 20 years, I don't think.
Capital flight, I would say maybe 30% chance.
30?
30. In 2 decades.
Oh, 2 decades. Okay. Okay.
Not
Okay.
an immediate problem. Okay. Yes, quickly. Yes, please. I'm sorry if I missed you before, but
Paul Thurston, Aoyama Gakuin University. Trying to channel my best optimistic Jester Cole here. So, if with a sustained
could you turn the microphone up towards your mouth, please?
with a sustained Japanese weak yen, doesn't that promote further FDI, therefore increasing competition, therefore solving the productivity problem, and our problems are solved?
I think a few things possible,
No.
right? No?
Now, the reason is foreigners would love to invest in Japan. The problem is the healthy companies they would like to buy are not for sale. That foreigners, companies that are in corporate groups, some of them being hived off into private equity firms, but in general, if you look at where foreign investors have invested, they've been able to invest in non-group companies, either on the stock market or not. But the most attractive targets are these healthy companies or even mediocre companies within corporate groups that in a different corporate structure, a different kind of company could use them better, would perform better. And those they are not allowed to buy. I could go on, but I won't. And that's why Japan was 196th. A weak yen does not change that situation. So Jesper is interesting, but in my view, incorrect.
Just in a 30 seconds.
Of course, yes.
So my answer is also no. I mean, exchange rate is one of the variables, relevant variables. So exchange rate, availability of workers, taxation, risk of natural disaster, many things.
okay. Okay, well, we are on time, I'm afraid. It's exactly 10 o'clock, so that's our official ending time. Let me thank both speakers, and as I said earlier, I hope we've made up in quality what we lacked in quantity. So, and we again send our best wishes to Jesper Cole for his speedy recovery. Okay, it's my pleasure to offer you both 1-year honorary memberships. Shirakawa-san, that's your honorary membership. And Richard, that's
Thank
your
you.
honorary membership. So please join me in thanking our speakers today.